The S&P 500 closed just a fraction lower here today, so essentially flat, whereas we did have strength in the other three major U.S. equity indices. Not a whole lot of news out there to push the markets around dramatically, but we did hear some positive vibrations from stocks like CrowdStrike and DocuSign and a few of these other momentum-oriented names that had been stars of the market earlier in 2020. So we'll discuss all of that, then we'll get into a trade application example where I wanted to focus on a bearish trade setup on a discretionary stock, since that sector is starting to lose a little bit of steam on an intra-week basis. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's December 3rd, 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click on subscribe on our channel, then go down to the description area and sign up for our email distribution list. We're also heavy users of Twitter. Feel free to follow me if you're not doing so already. My handle is @BrandonVanZ, and I really appreciate those of you that click like and retweet on these Market Outlook related tweets. Last but not least, we also have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into our action here today. And as you can see, I'm starting off with chart 4B here. This is just a simple four-grid that will show us the four major U.S. equity indices, and it gives us an opportunity to kind of compare and contrast as to where the strength or lack thereof is on any particular day. As I mentioned in the intro, the S&P 500 was actually our laggard today. It was the only one out of these four that we see here that closed lower. But then again, I think we could get away with calling that a flat day. It was down 0.06%, so pretty much nothing. In fact, along the way, it actually hit an all-time high. As you can see, our label right here is just over today's candle. You also have that green label showing up that appears whenever you hit a new 52-week high. So anyway, we did have an intraday all-time high on the S&P 500 before closing just a hair lower. The NASDAQ also hit a new all-time high here today. Unlike the S&P 500, the NASDAQ did also achieve an all-time closing high as it closed 0.23% higher. So pretty strong day there for some of those technology-oriented stocks. We also saw strength out of the Dow Jones Industrial Average, 0.29% to the upside. Didn't quite get to a new all-time high there. We were not able to achieve a high greater than where we were trading back here on November 24th. And then last but not least, the Russell 2000 also finished higher today. It was up 0.58%. So it was actually the leader of these four here today. And that's a theme we've been discussing for really the last 2.5 months now at this point over in my factor-based swing trading class, where the low size factor has been atop the rankings of my factor selector. In fact, we'll probably look at that here in just a little bit. But anyway, one other thing I wanted to point out in regards to these small cap stocks is down below here, if you look at the market sentiment label, it's the orange label on each of these charts. Notice how much stronger the market sentiment label is on the small cap universe than it is for all the rest. With the small caps, we're up here in what would be deemed the upper reversal zone above 80 at 83, whereas we're still sitting in the 60s on all of these other charts here. Now remember, the market sentiment line we don't discuss all that much in this presentation because it is a little bit of a further look back period. We tend to focus our efforts on the green intermediate time period, which is the last few months. But nonetheless, it is worth noting just because there is such an extreme difference there, and it kind of goes to show you that the small caps have been cooking for a while now and are still exhibiting strength at this moment in time. In fact, if you were to go back and look at how long the small caps have had their strongly bullish posture according to the green intermediate line, that would go back to this candle here on November 3rd. You can see the background color of the chart switches from pink to green on that day, signifying that the green line stopped going down and reversed and went higher, and now has effectively stayed in that upper reversal zone that entire time. So we are on quite the extended run in terms of an intermediate bullish posture here for the Russell 2000, whereas the strongly bullish posture, so when we went from light green to dark green in the case of Dow Jones, that was on the 6th of November, so a little bit later. With the S&P 500, it was the 16th of November, and with the NASDAQ Composite, it was also the 16th. So in other words, the Russell 2000 has had a strongly bullish posture longer than all of the other indices out there. So the small cap trade is alive and well as we speak. Now, obviously, as you look at the charts, we also have, in addition to strongly bullish postures across the board, we do also have stocks that are trading, or in this case, indices that are trading above their rising 30-day moving averages. So in other words, strength, bullishness, right? And that's what we've been exhibiting here for quite a few weeks, really since the election time period. We've been in a runaway market to the upside. All right, let's go ahead and take a look at our next chart setup. This will be our 3 green arrows chart setup. And as you can see here, we do have 3 green arrows on 2 of our charts. So when I did this presentation on Tuesday, it's still the same 2 as then, which is the S&P 500 and the NASDAQ Composite. Both of those have the green background colors over the candles on this chart 4D. And that suggests that we have what's known as a 3 green arrows signal. And a 3 green arrows signal is just kind of a fancy way of talking about 3 different technical indicators and describing the fact that they're all bullish at the same time. The 3 different technical indicators that we're using are the 30-day moving average, the MACD histogram, and the stochastic. With the Dow Jones and the Russell 2000, there we do not have 3 green arrows, which is why we have a white background color. Remember, if we ever had 3 red arrows, which we did some time ago, it would be a pink background color. So now that they're white, it basically means there's kind of opposing thoughts there. There are some green arrows and some red arrows. As it stands right now, on the Dow Jones, we have green arrows on the 30-day moving average and on the stochastics, whereas we do have a little bit of a loss of momentum there on the MACD histogram. That's where our red arrow is coming in, and the same thing is happening down below with the Russell 2000. One thing I would say that distinguishes it a little bit is the fact that the Russell 2000 stochastic looks to be stronger to me. Notice that its current reading on its stochastic is, let's see, 86.37. I'm getting that number, by the way, right here. I know it's probably hard for some of you watching on a cell phone to see, so that's why I'm reading it off to you. It's 86.37, whereas if we look up here on the Dow Jones, it's at 76.86. So in other words, we've got a lot more strength there, 10 basis points more, or you might even say 100 basis points more, depending on how they break that down. But 86 versus 76 on the stochastic. So of the 2, while they look somewhat similar, I would say that the Russell 2000 has the decided edge over the Dow Jones Industrial Average when it comes to strength at this moment in time. All right, let's go ahead and take a look at our 1040 crossover method now. And remember, this is a chart that doesn't see a lot of changes in terms of signal changes because this is a less sensitive approach to the markets. Sometimes folks will use a 1040 crossover method if they are trying to manage their 401k accounts where they can't have the opportunity to actively trade their portfolios the way that they might with their normal brokerage accounts. And so you're basically just trying to catch the major movements when you're using a philosophy like that. And as it stands right now, we've been in bullish territory for many months. Remember, each one of these candles that you see on the charts represents one whole week in length. And this chart is 3 years in length. So 3-year time period, each one of the candles one whole week. And so as an example for the NASDAQ Composite, we actually got a bullish crossover back here the first week of May, and we have continued to be bullish from that long-term philosophy ever since then. So yes, it was unfortunate that there was a whipsaw that occurred with the big downdraft with the coronavirus, but you know, that's part of the game. No signal's ever going to be perfect. And the good news is you didn't have to linger all that long, and you were back into the market relatively quickly as well, and more than offset any losses that you might have taken during this whipsaw period by the gains that eventually unfolded after the fact. So anyway, not a whole lot to report there other than we are seeing additional strength kind of creeping into the system. Now, one way to judge that is when you're looking at the blue and the orange lines here. First of all, if you're newer to this video, the orange lines are the 10-week moving averages. The blue lines are the 40-week moving averages. And so when I refer to something like a golden cross or a bullish cross, what I'm saying is the orange line is going up and through the blue line. If you ever hear the opposite terminology, or a negative cross or a death cross, then that would be the opposite, where the orange line is going down and through the blue line. So right now we have bullish crossovers that we're dealing with, and the one that kind of strikes me as being the most interesting right now is that Russell 2000. Notice that the weekly and daily PPO line down below here in the purple is basically at its highest level in the last 3 years. That's a good sign. It's telling us that we have the greatest amount of separation between these two lines on the chart, the orange line and the blue line. And that is telling us that in the shorter term perspective, we have more strength, right? There's this orange line, because it's more sensitive, because it tracks less time, is going up at a rate much faster than this less sensitive blue line, and that is generally perceived as a bullish attribute. Now, of course, along the way, it's also worth noting that in the last 3 weeks or so, we broke to all-time highs, right? We discussed that a few weeks ago when it happened, but just to reiterate that point, you'll notice that the Russell 2000 had its previous all-time high back here in September of 2018, and it made that index a lot different than the other three. The other three had already been celebrating all-time highs this year. Russell 2000 was a laggard. They had not hit a new all-time high up until the last 3 weeks, and it had to go all the way back to 2018 since they were able to say that. So these last 3 weeks have been important ones for the Russell 2000 as it got up and over those previous resistance points, and again, it's a good sign to see that PPO at its highest level there, telling us that we do have short-term strength within those small cap stocks. All right, let's go ahead and pop on over here to the internet, and wanted to, first of all, thank you for those of you that click like for me. As you know, my goal is always to try to get to 100 likes. As long as I get there, I'm happy to give kind of a full-length 30-minute video. If we're less than 100 likes, then I'll try to get through it in a much shorter amount of time, maybe 15 minutes or something along those lines. So anyway, depends upon whether you like a lengthier analysis or whether you just want to kind of get on with things. But nonetheless, those 100 of you that support me and David on a daily basis, you are recognized. We definitely pay attention. David and I both use Twitter more than we use any of the other social media outlets, and so that is the one that we kind of pay attention to more often than not. So thank you to those of you that spread your enthusiasm about these free YouTube videos by clicking like there for us. It means a lot. Now, earlier today, I taught my question and answer session, and that is the class here that's for premium members exclusively, that allows them to ask me direct questions about stocks and trade setups that they are interested in, and allows me to kind of review their trades and whether they're on the right track or not, or at least do my best in doing that. And so feel free to check out that recording later on if you weren't able to attend that class live and you are a premium member. It is posted to our Trading Rooms tab there. David taught his portfolio management with ETFs class as well. And then tomorrow, David will be teaching his technical analysis class. Now, a quick programming note there. He usually teaches that a little bit later in the day, but I think he's got some things going on this weekend, so he needed to move up the time. So if you are a regular attendee of his technical analysis trading room, make sure that you are aware that tomorrow, for 1 week only, it'll be at 10 a.m. Eastern Time. Also, while we're over here on the internet, I wanted to show you here some movement that we saw in the factor selector this week. So as I mentioned earlier in the presentation, no surprise to see low size factor at the top Remember, that's something that we had recognized going all the way back here to the final week of September when we saw the low size category go from number 4 all the way up 2 slots to number 2 and eventually take over the number 1 slot at the beginning of November. So the small cap stock rally that a lot of people are just finally waking up to now has been common knowledge for those of you that attend my factor-based swing trading class on Wednesday mornings, where we review this data every single week. One thing I did want to point out to you is that we did have a shakeup kind of in the middle of the group here. You'll notice that week over week, we did see that the momentum category is starting to come back to life a little bit. That's music to my ears, because one of the trading rooms that I teach is a top-down trend trading class, and that effectively is a momentum-based trading class. And so that one kind of stalled out there for a while. It was the leader for much of 2020. We have had some phenomenal success in that class this year. I cannot be happier with the decisions those students have been making in 2020. This has been one of the best trend trading years on record. But we've kind of stumbled, and our account value basically went sideways for the last month. But just this last week, we went back to all-time highs in our account value, and that makes sense because I'm seeing that momentum category starting to perk up a little bit here again. Now, speaking of which, one of the stocks that we do own in that top-down trend trading class is CrowdStrike. And as I say here on Twitter, for those of you that follow me there, you might have already seen me post this earlier today, but I said CrowdStrike is one of the crowdsourced holdings from our top-down trend trading class at Market Scholars. Now, what I'm referring to there is, those of you that haven't been to my classes, what happens is I come up with a bunch of trade ideas. In the case of the Monday class, I come up with 3 different trade ideas that I think fit the class rules, that fit the class goals and the spirit of what it is that we're hoping to accomplish, in that case top-down trend trading. And then I kind of go through all the pros and cons of why that may or may not be a good trade setup for our purposes. And then all the classroom attendees that are there will absorb that information. In fact, they will help one another. I invite them to also share their thoughts as far as what are some pros and cons that they are recognizing out of either the stock's chart or the business model or whatever's on their mind. And then at the end of class, we all vote upon what we think is the best candidate that week. And whatever one wins the vote gets added to the portfolio, and we also remove one of the laggards. So anyway, it's a fun class that has a lot of crowdsourcing available in it, whether it's through the analysis of the pros and cons from the student audience, or whether it's just through the voting to populate the portfolio or not. And CrowdStrike was one of those crowdsourced selections that we had some time ago. I said it feels good to see it back at all-time highs because it's been a while, because it's kind of followed the momentum factor that I mentioned a moment ago. Momentum was riding high for much of 2020, and then in the last month and a half, it's just kind of taken a little bit of a break and let a few of the other areas of the market start to excel. I also say it's also nice to see a fresh set of 3 green arrows on a weekly candle chart. And if I click on this here, you can see that in a little bit greater detail in how that CrowdStrike chart looks. Now, this is a 1-year weekly candle chart, so every one of those candles is 1 week in length, and you can kind of see here that over the last 5 or 6 weeks, it's effectively gone nowhere. And then today, all of a sudden, it went up 13% off of its earnings announcement, and we now have a new, fresh set of 3 green arrows, hopefully continuing that trend ever higher as the months and the years roll on. All right, let's get back on track now with some of our Thinkorswim analysis charts. Let's start doing some 12 grid analysis. And so for that, I'm going to pop on over here to 5A, and this will be our asset class 12 grid. Now, as we're looking at this, a reminder that these 12 grid charts are a little bit too small to have the background colors changing so rapidly based upon posture change from bullish to bearish to bullish to bearish to bullish to bearish, like our full screen 1 grid charts. So the way that these ones work is the background colors will just tell you what is the current posture, not what it might have been last week or last month or what have you, whatever the posture is at this exact moment in time. And if the charts are green, That means that they have bullish postures according to the intermediate line on the market forecast technical indicator. And of course, if the charts are pink, that means that they have a bearish posture. Now, there are different shadings involved as well. So technically, there's kind of 4 different colors. There's a dark green, a light green, a dark pink, and a light pink. And we actually have examples of all 4 of those colors here in front of us. So as an example, down here on this bottom rung, you can see that oil has been doing quite well here recently. In fact, the oil and gas kind of energy sector has been an outstanding performer, as I mentioned on Tuesday, over the past month. And a lot of that is as a result of oil prices continuing to move higher, regardless of what OPEC says, right? We've seen another nearly 1% move higher in oil today, and we are trading near the highs of the last 3 months there. So that has a dark green background color because the intermediate line is at 90. And although it's falling, remember, because it's above 80, in other words, the upper reversal zone, we consider that to be a strongly bullish posture. Whereas the chart to the left, gold, is also green. However, notice the background color is light green in this case, not dark green. And the reason is we would consider this to not be a strongly bullish posture, but a weakly bullish posture. In other words, we've seen enough strength to give us some optimism, but we're not going to hold our breath until we see a little bit more stability. Right now, you can see the intermediate line on gold is at 20.63 and rising. I broke that out to the decimal because it's important in this case. Remember, the lower reversal zone is at 20. So if this said 19.99 instead, this would be a dark pink background color. But because it emerged out of that lower reversal zone, it's got to start somewhere. It did have enough oomph to give us a weakly bullish posture. But I think most of you can see by the shape of this chart that you better be awfully careful putting too much emphasis in a bullish trade on gold right now. I'd say right now the path of least resistance continues to be to the downside despite a pretty nice pop higher here in the short term in the last 4 days or so. Remember, we've gotten those oversold cluster signals down there in those green dots. Telling us that a reversion to the mean type of a move is entirely possible, and that is what we're seeing right now. But it still hasn't changed the trend. The trend continues to be a downtrend there for gold, as it seems like the enthusiasm these days is all about Bitcoin rather than gold. We'll see how long that lasts, but so far so good for those of you Bitcoiners out there. You can see over here to the chart to the left is the US dollar. Now notice that's a dark shade of pink telling us that we have a strongly bearish posture in this case. Now be aware that the US dollar has also started to rack up a lot of those oversold cluster signals. So are we on tap for the potential of a reversion to the mean type of a move to the upside, somewhat similar to what we're seeing out of gold over here? I'd say it's entirely possible. Remember, these markets tend to not go straight up or straight down. There's kind of chop and slop and backfilling and all kinds of things that take place. So don't be surprised if the US dollar does get a little bit of a pop here in, let's call it the next week, perhaps 2 weeks. But the question will be, is it trend changing? And the answer, just like I gave you for gold, is probably not until we see further evidence of stability on the chart. Right? There are times where trend changes can occur, but it's got to prove it to us. More times than not, the trends hold. Right? During this chart, let's say for TLT above it here, you've had a lot of those reversion to the means types of trades, where at those times the posture would have been bullish and then it reverted right back down into its downtrend. There are other times, however, like with the oil chart here, where it was in a downtrend, it eventually gives us enough of an oomph over the moving average, starts stabilizing there for a few weeks, and then starts making a move to curl that moving average higher. Then you're starting to think that's a more legitimate move that's taking place there. But the point is, you want to start establishing a presence above a rising 30-day moving average. So regardless of what the postures are on the US dollar or gold, right now, I would feel a little bit more hesitant towards taking bullish trades on either one of those until I see stability above a moving average, kind of like what we're seeing there with oil. Anyway, as we look at a few of these other charts here, we did find that interest rates fell a little bit today. Now remember, this is a beautiful looking chart, so yeah, it's down a little bit today, but it remains in a very vigorous uptrend there. And likewise, the opposite of that is U.S. government bonds themselves did rise today, but they remain in a vigorous downtrend. And we have a bearish trade on TLT right now, so we're going to be continuing to cheerlead that until that trade is off our books. But right now, despite the move higher here today, it remains with a strongly bearish posture. In terms of the stock markets around the globe, once again, continued theme emerging, which is we find foreign investments doing a little bit better than domestic investments. Notice that today, EFA, to start with, is up 0.17%. EEM was up over 1% here today. Both of them hit multi-month highs here today and finished higher. That is better than what we saw in the United States, at least from SPY's perspective, where it closed a little bit lower. And you can see that even if we look back further in time, SPY is only up 6% over the last 3 months. EFA is up 11% over the last 3 months. And EEM, the emerging foreign markets, are up 13%. So like I mentioned on Tuesday, don't fall asleep on the rest of the world. Sometimes we have the tendency to put the blinders on here in the United States. And quite frankly, we've been fortunate for the last decade to have such superior stock market returns. But remember, it's a beautiful world out there. And we have a global audience here, by the way, as well on this YouTube video. So for those of you outside of the United States, thanks for tuning in. We appreciate you as well. But naturally, our audience is mostly US based and sometimes needs a little bit of a poke here and there to remind them there are lots of good stocks and lots of good foreign ETFs out there outside of our own borders. In fact, that is a topic that David gets into regularly with his class that he does teach on Thursdays, which is the Portfolio Management with ETFs class. I know he's been pushing a lot of his class's exposure into foreign ETFs. So that makes perfect sense to me as well as we kind of review these 12 grids. All right, real quick on the sectors. Today, let me just show you real quick on the 12 grid. Oh, hang on. I clicked the wrong one. My apologies. I wanted to go to 5C. On the sectors, our bigger movers were out of the energy space here today. You can see oil and gas stocks were up over 1% to the upside. And our bigger movers on the downside were utilities, down over 1% there. So anyway, that kind of jives with what I was showing you guys on Tuesday in terms of how our sector selector rankings were shaking out here more recently, with energy making a big surge recently and utilities now in the dead last position on that graphic. One thing I wanted to bring up regarding that is that this is a chart that I'm going to be releasing to our premium members here within the next month, so it's not available yet. But one of the neat features of it is that it allows us to see on an intra-week basis, so not just on Fridays like I've been showing you guys throughout time, but throughout the week, where our rankings are falling at any particular time. And so you'll notice, as an example, there's your utilities down at the bottom. That's that yellow line. And energy had made a big move as of last Friday's close. It's pulled back a little bit, but still well off the lows of where it spent the vast majority of its time in previous months. But the one that I wanted to point out real briefly here, just because it fits into my trade application example, is discretionary. Discretionary had been a leading area of this market, and in the top 3 ranks of the 11 sectors of this sector selector graphic, which uses what I refer to as the WAR score. It's just, WAR is an acronym, stands for weighted aggregate returns. But anyway, point is, it's our scoring method that we use for my top-down trend trading class. And we've been focusing on a few discretionary stocks here and there along the way. And for the most part, they've done reasonably well. You know, stocks like Nike and Starbucks were hitting new highs today as an example. But there are some little elements within discretionary that are starting to falter a little bit. And there seems to be a little bit of a theme around home building or home furnishings that is sputtering a little bit right now compared to what we saw earlier in the year. So anyway, you will notice that if I were to do the rankings right here, right now, discretionary would have slipped 1 in the rankings from 3 down to 4. Not a big deal, but maybe a little bit of slippage that's taking place there. And it kind of fits the theme of our trade application example that I want to share with you here. All right, so let's get into that trade application example. And I'm just going to pull up a chart for this normal market forecast 1 grid. And I want to show you ticker symbol Lowe's. Now, before I do, let me also show you ticker symbol HD, which is Home Depot. You look at that chart, and you probably are not enthusiastic about it if you are hoping that it's going higher, because it really isn't. Home Depot has largely just been going sideways for the last 3 months here with a slight tilt downward. Notice that Home Depot is faltering and has a bearish posture now, according to the market forecast, and also has that red 30-day moving average signifying price below the moving average. So Lowe's is kind of following suit. You'll notice that Lowe's has kind of been forming this downtrend here more recently. Now, those of you that have attended my dividend classes know I'm a big fan of Lowe's, so I don't want this to distract you from it because I do like Lowe's as an investment for the long term if you bought it at the right price, i.e. earlier this spring when it was yielding 3%. Now that the stock has skyrocketed higher from its lows back in March and April, it may have decided that it went up a bit too far too fast. So to kind of put that into perspective, let me show you the 1-year chart of this. This is what I'm referring to. This stock was a $60 stock. This was a company that we reviewed in my dividend growth investing class here in mid-March when it was yielding over 3%, right around mid $60 level. That has absolutely erupted to touch 180 at one point. So my thinking is that was a little bit too good to be true, right? That's an enormous move for a mega cap company like this. And it's possible that it got a little bit too big for its britches, a little bit too hot, and perhaps needs to give a little bit of that move back to kind of right size itself. And that's kind of where we're at right now. You can see a decided tilt in this chart right here, where we had a clear uptrend taking place for much of the summer into the fall, but here in the last couple of months, it started to spill over to the right-hand side. So what I decided to do in this case was to sell a bear call spread. Now remember, how I do this is I actually place the trades while the stock market is open, and then I send that information out to all of you that are premium members of Market Scholars using our Telegram app. So the trade's already done, and you guys have access to checking out what the fill prices were and the time I executed the trade and all that kind of stuff as well. But for those of you that are not premium members, I'll just say that the bear call spread is a way for you to make money if the stock does not go higher significantly. Now, I use the January contract, so we've got about maybe 45 days or thereabout before expiration. And I did have our sold strike here above the moving average. In other words, as long as this stock stays below its moving average, we'll make money on that trade. It can even go up a little bit. Now, preferably, for the trade's purposes at least, I do want Lowe's to continue to struggle and go a little bit lower. But if it went sideways, I'd be fine with that as well. And if it went up just a little bit but didn't go up too much, I would be okay with that as well. And we got about a 30% return on risk with that trade that we did there. So anyway, that was the trade application here for the day. Strongly bearish posture on Lowe's. Stock trading below its 30-day moving average, which itself is falling, and a stock that was once very, very hot just a few months ago that is kind of turned cold here more recently. And remember, Lowe's and Home Depot and some of those big box stores, they had the benefit of being open as essential retailers during the coronavirus crisis back in the spring. And they were the only place in town for some purposes if you wanted to go out and spend some money. These days, with the vaccines on the horizon, there's a lot of stores that are open now, or at least will be opening shortly. And therefore, Lowe's and Home Depot are going to have a lot more competition from all of the other stores, mom and pop stores that are opening up out there. So perhaps that's kind of what the market is thinking here by giving it a little bit more bearishness in the last month or so. So that's what I had for you for today. If you appreciate these videos, if you appreciate the analysis, the prep work that goes into them, the trade application examples, and all of that jazz, one thing I can ask from you. Just simply click like on Twitter. That's it. Pretty easy, right? 5 seconds. That's all it takes. It'll be pinned to the top of my timeline. All right. With that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.